Welcome back to Investing Talk Podcast.
Today we're looking at Constellation Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Constellation Energy is, it's a really fascinating case right now.
It really is. I think the first thing that jumps out to me, the thing we have to unpack, is their financials.
Absolutely, because on the surface, you see one thing, but the real story is somewhere else.
Right. You look at the top line for 2024, and revenue saw this, modest decline. It's about 5.4%, down to around $23.5 billion.
And normally that's a red flag. Shrinking revenue, investors get nervous.
But then you look at the bottom line, and it's just a completely different picture. Net income didn't just grow.
Yeah.
It exploded.
It really did. 131% year on year. It landed at, what, $3.75 billion? That's not just growth. That's the total transformation in profitability.
131% on falling revenue. So what's the mechanism there? How does a company pull that off?
It's all about margins. It's almost entirely a story of immense margin expansion and really tight cost control.
So they have pricing power.
Huge pricing power. Their net income margin basically doubled in 2024. It jumped from around 8% to 16%. That tells you that in a really volatile energy market, they weren't just reacting, they were setting the price.
Because they have something that's becoming more and more scarce.
Exactly. Reliable, clean, baseload power. It's incredibly high demand. So they were making way, way more from every dollar of revenue they bring in.
And you see that strength across the rest of their financials, right? The balance sheet.
Oh, absolutely. The balance sheet is solid. Debt is manageable, and this is the crucial part, their free cash flow is just robust.
And that's the ultimate health indicator for a big utility.
It is. And that FCF is what lets them pay out a consistent dividend, which, it just signals that management is confident this isn't a one-off thing. They believe in their performance.
And they're guiding for that to continue. I saw they just narrowed their 2025 earnings guidance.
Yeah, to a really tight range, between $9.05 and $9.45 per share. When a management team does that, it tells you they have a very clear view of the road ahead. It's a big vote of confidence.
Okay, so the fundamentals are stellar. But that ties into the second piece of this, which is maybe even more important, their competitive moat.
This is where it gets really interesting. Because they're not just another utility company.
No, they operate the largest carbon-free generation fleet in the entire country. They are the undisputed leader in nuclear power.
And nuclear is the strategic asset right now. It's the absolute backbone of clean baseload supply.
Explain that a little more. What makes baseload so critical?
Well, baseload means it's on 247. Unlike solar or wind, which, depend on the weather, nuclear just runs. It's carbon-free, but it's also completely reliable.
And in today's world, that reliability is turning into a massive financial advantage.
It's a financial hedge you almost can't beat. Think about their main competitor for baseload power, which is natural gas.
Volatile commodity prices, carbon liability risk.
Exactly. Constellation's nuclear fleet has predictable costs and almost zero carbon risk. It makes them more stable, and it puts them right in the path of this electric power supercycle everyone is talking about.
Which is driven by the push to decarbonize everything.
And it has political backing, too. We're seeing real bipartisan support for nuclear expansion, which is critical.
And that advantage is only going to get bigger, right? With the Calpine merger on the horizon?
That merger is a potential game changer. It's set to create the nation's largest and most flexible generation platform.
But a deal that big, doesn't that come with huge integration risks? Mergers of this scale can get messy.
That's the key risk, and we should definitely talk about it. But the strategic logic is it's enormous. It expands their scale, and it integrates everything, nuclear, gas, wind, solar, hydro, all under one roof.
Yeah.
They become this indispensable provider.
So the strategy is impressive, the numbers are impressive. Does Wall Street agree? What are the analysts saying?
They love it. The optimism is almost universal. Over 80% of analysts covering the stock have it as a buy or a strong buy.
Any specific price targets that stand out?
A few, yeah. Wells Fargo initiated coverage with a target of $478. KeyBank is at $417.
Wow.
Yeah. And even the average target across the board is around $386. That's still, about 14% upside from where it's trading now.
So the sentiment is clearly bullish. What about the technicals? Did the charts back that up?
The charts line up perfectly with the fundamental story. The stock is in a very clear long-term uptrend.
Yeah.
Higher highs, higher lows, just what you want to see.
And it's not just retail investors jumping on the bandwagon.
Not at all. We're seeing reports that major institutional players, we're talking pension funds, big mutual funds, have been increasing their positions. When the big money moves in, it shows conviction in the long-term story.
Okay, so fundamentals, moat, and market sentiment are all aligned. Let's look forward. What are the catalysts that could push this stock higher?
Well, in the short term, there are two huge ones. First is the Q4 2025 earnings report. That's coming up in early February 2026. Given their margin story, another big beat could really move the needle.
And the second one is the merger.
The Calpine merger, exactly. The closure is expected by the end of 2025. Any updates on a smooth integration will be watched very, very closely.
And beyond just the numbers, what about innovation? New products?
We're hearing about new launches aimed right at their big industrial customers, things like custom solutions for decarbonization, even synthetic fuels. They're leveraging their clean power to create premium products for companies trying to hit their own net zero goals.
Which connects to the biggest picture of all. The macro tailwinds here are just immense.
They really are. And it's more than just EVs. The real story is the explosion in demand from data centers, specifically from artificial intelligence.
AI is just unbelievably power hungry.
Insanely so. This isn't just a small increase in demand. We're talking about massive incremental electricity needs. And it's a very specific kind of need.
Right. Data centers can't have downtime, not for a second, and they need to be green.
Precisely. They don't just need power. They need constant 247 reliable, clean baseload power. Wind and solar can't deliver that on their own.
Not without massive, expensive battery storage.
Which leaves nuclear. Constellation is one of the only companies that can provide this high-density, zero-carbon product at the scale these tech giants need. They're becoming a critical partner for the entire AI revolution.
That feels like a structural advantage that could last for a decade or more.
It does. And, there's even some speculative talk. I mean, it's just chatter for now.
Yeah.
But about a potential inclusion in the S&P 500 index if this growth continues.
Which would force all the index funds to buy in, a huge source of demand.
It's a major catalyst if it happens.
Okay, so the bull case is incredibly strong, but we have to be balanced. What are the primary risks an investor needs to be watching here?
Number one is the one you mentioned earlier, execution risk. The Calpine M&A is massive. If they stumble on the integration, if those synergies don't show up, it could really hurt the outlook.
That makes sense. And what about just the day-to-day business of running these plants?
That's the second one, operational risk. An unplanned outage at a nuclear plant is incredibly expensive and can hit earnings hard.
And finally, I assume regulatory risk.
Always, especially in this sector. Right now, political support for nuclear is strong, but a shift in the political climate could change market rules, subsidies, tax incentives. Things can change fast.
Okay, so to sum it up, what you have is a company with, truly robust fundamentals, amazing earnings, incredible margin growth.
And you combine that with these powerful long-term secular tailwinds, the energy transition, and especially this urgent need for clean baseload power to fuel the AI economy.
So it's attractive for growth investors, for long-term investors, pretty much a wide range.
It really is. But leaves you with a really important question to think about. In a world that's going to be dominated by these huge power consumers like AI data centers, how much of a premium should you put on a company that can deliver that reliable, carbon-free energy 24/7? Because that scarcity, it's only going to grow.